you so much for joining. Last time we discussed how we can use the dividend discount model to calculate a share price as one of the methods. Today I want to go into a little bit of more detail to explain you the relationship between dividends and the underlying growth rate and also their impact on share prices. So to recall, last time we talked about the growing perpetuity formula, which is the dividend in period 1 divided by the cost of equity minus the growth rate. We assume cost of equity throughout our example remains the same because it's given based on the investor expectation, based on the risk profile of the company and what we believe our hurdle rate should be. Dividend and growth rate is what we're interested about. And the key question here, how can we increase the stock price? If we just look at the formula without thinking much, there are two ways of doing this. First, very easy, increase D1. If we increase D1, then the share price would be higher, or what we could do is we could, as a second option, we could increase our growth rate. Yeah, if we have a higher growth rate, our denominator is smaller and our share prices increases. Good, what should we do? As a heads up, both is not possible. I will explain you why. So in general, if we go through the income statement again, and I will not start from the top, I start with EBIT minus interest minus taxes, net income, also called earnings. Good. Once you have generated earnings for the company, let's assume you have generated 100, then the company can decide, okay, what are we going to do? And let's assume the earnings here are per share earnings, doesn't matter, earnings per share, because we look at a per share perspective. You have generated $100 per share, then you can decide, okay, either I pay dividends and the remaining one, retained earnings, goes to our balance sheet. Yeah, so if the company decides to pay, let's say scenario 1, scenario 2, pays 0, then $100 goes into the balance sheet and is retained. Company can also decide, okay, we have 100 in earnings and we pay 100 in dividends, then no earnings are retained. And what is happening in general? Earnings reinvestment. The more you reinvest here, increase efficiency, the capabilities, you can pay new machines, new production lines. So because you reinvest money, your goal is that your growth rate increases because your company grows. You reinvest some of your money. If you don't invest, our assumption is G does not increase. The company does not grow because you're not investing. However, if you pay more in dividends, like here, higher, and here dividend is lower. So if the firm pays out a high dividend, here, low G, nothing to reinvest. If the firm pays low dividend here, can invest a lot, higher G. Yeah, so there are only two options. Either you choose high dividend, low G, or low dividend, high growth rate. You can't do both. Yeah, I've used the extremes here to illustrate, but you can't do both. So what is the trade-off? The trade-off in general is, again, if you think about how to define dividends, equals earnings. Yeah, per share, I've assumed my earnings 100 are per share, times dividend payout ratio. Yeah, here dividend payout ratio is 100%. Here dividend payout ratio is 0%. If my dividend payout ratio is 50%, I would have 15 dividends. Yeah. Yeah, 100. I've assumed 100 per share, 100. If it's 0, it is 0. You call the opposite, you call it earnings retention ratio. Earnings retention ratio. Yeah, here our earnings retention ratio is 100%. We have retained everything. Sometimes called plowback ratio. It's the same. If your dividend payout ratio is 50%, your earnings retention ratio is 1 minus 50%, 50%, and so on. So it's exactly the opposite. It's basically the proportion that is paid in dividends. Dividend payout ratio and earnings retention ratio is a portion of total earnings retained. So, how to calculate my growth rate? Growth rate, it's intuitive. Growth rate is first your earnings retention ratio. Yeah, which makes sense. The more you retain, we mentioned this, the more you retain, the higher your G. If you don't retain anything, your G does not retain. And then earnings retention ratio times return on investment. Yeah, if you assume your return of investment is 20% and your earnings retention ratio is 100% times 20%, your G is 20%. Now you have retained everything that you have. 100% times 20% is 20% growth rate. If we assume you are not reinvesting because you have paid out everything as dividend, then it's 0% times 20% equals 0%. You're not growing. If we assume maybe the midpoint, you have reinvested 50% times 20% equals 10%. Yeah, and this is a trade-off. In general, it's called law of conservation of earnings. Law of conservation of earnings, which says in general dividend payout ratio plus earnings retention ratio needs to be one or the other. And what you can do is either increase the next dividend, D1, by increasing earnings or by increasing the dividend payout ratio, or you can increase future dividends by increasing growth rate, yeah, by either retain more here, or for both if you increase your earnings. Yeah. And as a conclusion, a firm cannot simultaneously increase both your dividend payout and your earnings retention. There's always a trade-off. What you should do in general, if your return on investment is higher than your cost of equity, then retain earnings because your return on investment is good. So retain more to increase future dividends. If your return on investment at the moment is quite low and it's smaller than your cost of equity, then pay out dividends. And you can see this many times when the management decides, okay, should we pay out our free cash flow as dividends, then it's sometimes a sign that there are no good projects available at the moment where the company could invest at an adequate ROI. So then company decides to pay out dividends. Yeah, hope you find this useful. Thanks so much for watching. Talk to you later.